Welcome to this episode of the EFRAG podcast series outlining our discussion paper, Accounting for Crypto Assets, Liabilities, Holder and Issuer Perspective. As mentioned in the previous episodes, this series provides insights on crypto assets accounting. Today's podcast will focus on accounting issues for holders of crypto assets. To brief us on this topic, I have with me today Vincent Papa, EFRAG Associate Director, and Ana Rosa Cortez, Partner in Financial Services at KPMG Spain. Before entering the depths of our topic of the day, accounting issues for holders of crypto assets, Ana, you may want to introduce yourself and present us your specialties.
Thank you, Cecile. A pleasure to be here with you today. As Cecile mentioned, I'm a partner in financial services consulting at KPMG Spain, specialized in IFRS for banks and financial instruments accounting, as well as risk and regulatory issues around market risk.
Right, so now over to you, Vincent.
Thank you, Cecile. As you mentioned, the focus of this podcast will be addressing the IFRS accounting requirements by holders of crypto assets, as has been addressed in the EFRAG discussion paper. By holders, we mean holder entities or companies, including those who are doing so on their own behalf, as well as on behalf of others. By that I mean intermediary holders such as custodians and brokers. Notwithstanding the growing interest in the crypto space by both institutions and individuals, especially in recent times, when you think of IFRS requirements, the focus is on companies and not on individuals. With that being said, let me start by highlighting that in 2019, the IFRS Interpretation Committee published an agenda decision whose scope was on the holders of cryptocurrencies with no claim on the issuer, and that includes some of the more well-known crypto assets such as Bitcoin. Nonetheless, during EFRAG's research and outreach to stakeholders, it became evident that there are a variety of accounting issues across the spectrum of crypto assets that still need to be considered. Hence, Anna, my first question would be on your perspective on the Interpretation Committee's agenda decision and the extent to which it suffices to address the overall accounting for crypto assets.
Thank you, Vincent. That's an interesting question. So actually, compared to what we had before the EFRAG agenda decision, we have to acknowledge that it indeed helped clarifying the most adequate accounting treatment for holders of cryptocurrencies under the current framework. But let's recall first the role of the EFRAG to put this decision into context. The EFRAG addresses specific issues or questions that require clarification within the context of the existing IFRS framework. That means to provide a specific answer to a specific question. In terms of scope, the holding of some crypto assets where there is a claim on the issuer, as you said, this is only limited to cryptocurrencies with no claim on the issuer. And I'm talking about some stablecoins, security tokens, and utility tokens, and also the issuance of crypto assets fell completely outside the scope of the EFRAG decision. We have to say that those cryptocurrencies in scope represent a significant proportion of the overall crypto assets market capitalization. Other crypto assets liabilities were not yet considered prevalent in the market and were not posed as part of the initial question, but there is steady growth and can become more relevant as we go. In terms of outcome, although the EFRAG consultation considered the accounting requirements for intangible assets, inventory, cash, and financial assets, and clarified that cryptocurrencies have the characteristics of either intangible asset or inventory, depending on the purpose of holding the cryptocurrency, it finally decided that cryptocurrencies should be accounted for under IAS 2 when held for sale in the ordinary course of business, or else they should be accounted for under IAS 38. In summary, as we can see, there are quite several unaddressed issues under the current IFRS requirements, even for holders of crypto assets, cryptocurrencies, and moreover for holders of crypto assets in general.
Thanks, Anna. You mentioned IAS 38 and IAS 2. Can you give an overview of the challenges that may arise from the application of these two particular standards when accounting for cryptocurrencies?
Sure, Vince, that this is a quite debated topic at the moment. And let's recall that IAS 38 defines an intangible asset as identifiable non-monetary asset without a physical substance. And the standard is agnostic about the purpose for which an entity holds an intangible asset. Under the intangible assets accounting means, for instance, in the case of cryptocurrencies as decided by the EFRAG, they should be reported at costless impairment. As they have an indefinite life, there is no amortization. It's also possible to apply the revaluation approach at fair value through OCI, but only if there is an active market. It is broadly acknowledged by experts that IAS 38 was not written with cryptocurrencies in mind, and particularly when considering their price volatility and the purpose of being held as investment. Some go as far as to ascertain that the standards do not provide useful information for users and investors. And this is not a surprise. IAS 38 was issued in 1998 and could not possibly take into account the characteristics of crypto assets. We can summarize the shortcomings of the applicability of IAS 38 as follows. Most of the concerns are around not being able to recognize crypto assets at fair value through P&L, as all believe that provides better information to users and investors. There are also restrictions that the revaluation approach imposes towards fair value measurement in the absence of active markets. And also under the revaluation approach, if assets are sold, gains in OCI cannot be recycled. And also some other holders of crypto assets, such as exchanges, consider that cost-based measures do not reflect their business model. So there is significant evidence in the market that the most widespread interest in these assets for the moment is for investment purposes. Therefore, some specialists propose fair value through P&L as an appropriate measure for non-financial asset investments held for the short-term purpose, and fair value through OCI for those held for the long term, so similar to the financial instruments accounting. We have also to go back to the purpose. So there is a clear gap in IFRS at the moment, where currently we make the distinction between the accounting for tangible assets held for investment purposes, such as investment properties, or other intangible assets under IAS 16. And the accounting currently for intangible assets is not subject to similar distinction. So that we think this is a huge gap. Also, we have to recall that under IAS 2, one can account for cryptocurrencies as inventory held for sale or consumption in the ordinary course of the business. And also you can see here quite difficult to apply this definition for investment or treasury purposes. In summary, both solutions do not provide the response expected by users or financial statements, nor reflect the economic substance, value, and purpose. And we have also to highlight here that given the differing functional use by holders and the varied economic characteristic of crypto assets, it makes it really difficult to come up with a single measurement basis for all the crypto assets in all circumstances. Therefore, we need to watch this space on a continuous basis.
Thanks. And on the point that you flagged of fair value through P&L being possibly the appropriate measurement basis, particularly when you consider the price volatility of crypto assets, and given that they're often held for investment purposes, as you mentioned, can you comment perhaps on the potential applicability of IFRS financial instruments accounting requirements and the extent to which you may get the appropriate measurement approach if you apply financial instruments accounting, and if some of the other crypto assets such as security tokens could fall within the scope of such requirements?
Sure, Vincent, that's a very interesting question. So let's recall what is the financial asset under IAS 32. This is cash, an equity instrument of another entity, a contractual right to receive cash or another financial asset of another entity, a contractual right to exchange financial assets or financial liabilities with another entity under potentially favorable conditions, or a contract that is settled with a variable amount of equity instruments. So as you can see, it's quite broad and wide in the definition, and we could fit some of these crypto assets effectively. Besides cryptocurrencies, which deserve a consideration as cash, but even more appropriate as financial assets, it seems now that is the most adequate accounting answer as it stands today. There are other instruments, such as some security and asset tokens, as you mentioned, like, for example, tokens backed by real estate and equity-based tokens that have equity-like features that show financial instruments-like characteristics. We also need to consider here that the economic rights and obligations of these securities and asset tokens are extensively documented in similar manner to traditional capital market securities. But some other security tokens by issuers may not always qualify to be accounted for as financial assets by holders under IFRS requirements, even though in some cases such tokens may have economic attributes similar to financial assets. That is why some are calling for a development of specific IFRS principles on crypto assets and liability, as some of these assets present various indicators of similarity. Another aspect to consider here is why the definition is not exactly fitting. And that is because the contractual features of smart contracts may not fit within the IS-32 definition of enforceable contracts. So the main question is around whether there is a contract in the legal sense in the first place. And while here the debate continues, let me clarify that IS-32 indicates that contracts can take on different forms as long as they're enforceable. So back to the enforceability question. So if they were enforceable, probably they will meet the definition of financial instruments. So in summary, I do not consider this stage to change IFRS 9 or IS-32 to cater for the characteristic of crypto assets in general, but clearly there is a need to clarify the accounting for cryptocurrencies as financial assets if we consider the shortcomings of IS-38 and IS-2 as we mentioned. And moreover, I believe that some additional guidance for security tokens, utility tokens with investment risks should be produced until a clear need arises to issue an independent standard on crypto assets and liabilities.
Thanks. And on your very last point on possible additional guidance, I would also highlight that our discussion paper comprehensively evaluates and proposes specific areas for clarification in the accounting for security tokens, utility tokens, as well as hybrid tokens. And indeed, as you've pointed out, an analysis of the economic substance and the enforceability of rights and obligations is always key. And as some would say, if it behaves and looks like a duck, it's likely to be a duck. Now, moving on to another accounting aspect. Several central banks are considering launching their own digital currencies, also referred to as CBDCs. And there's also been a growth in stable coins, including those that are pegged to fiat currencies. Hence, a question arises on whether the IFRS definition of cash and cash equivalents needs to be updated. What's your perspective on this particular question?
Well, let's remember that under IS-32, cash is a financial asset because it represents a medium of exchange and is therefore the basis on which all transactions are measured and recognized in financial statements. While IS-7 defines cash equivalents as short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. As we can see, there are many challenges posed by the definition, and they're huge. And the implications of considering these crypto, let's say, currencies at the moment as cash are huge as well. So many experts highlighted that the definition needs to be updated because it's restrictive and needs a consideration of different aspects, not only because of crypto assets, but in general in the past as well. Some emphasize that the medium of exchange ought to be the defining characteristic of cash. So you can use it and pay with this currency. And question whether cryptocurrencies need to be a unit of account for recognition akin to a functional currency. For the most popular cryptocurrencies at the moment, it is clear that the definition does not fit exactly and seems more like a financial investment rather than a currency. So this is at the moment the tendency to consider these cryptocurrencies under the accounting. Accounting clarification is more required in respect of CBDCs because there is a question of the equivalence of these CBDCs with cash, its legal tender feature, and whether or not a right to restitution will be granted to token holders. I think it's appropriate to address this issue, considering the ongoing development of the CBDC concept and the potential implementation as few countries, monetary authorities like China and France, have signed, and I think they're working on that in this year. So in summary, an update to the IFRS definition of cash could be considered by the ISB. Yet if such an update was to result in some crypto assets being classified as either cash or cash equivalent, it could have significant consequences. It could incentivize increased holdings of these crypto assets by entities, including financial institutions, and this in turn will have implications on monetary policy and financial stability.
So clearly there are a whole range of ramifications to consider. Now, as a final question, a key area of clarification is the accounting by intermediary holders, and that includes custodians and brokerages. Can you comment on the arising accounting issues?
Sure. I think here the central question is to determine which party, depositor, client versus intermediary, has economic control and thereby needs to recognize it on the statement of financial position. Although there is practical guidance that proposes a whole raft of indicators on who has economic control, there is a need to consider specific contractual arrangements in applicable jurisdictional laws and regulations. Let's consider that currently, other than IS 8, there's no IFRS guidance for holders on behalf of others. So there is also diversity of contractual arrangements and the existence and content of jurisdictional regulatory requirements in respect of third-party holding of crypto assets, which need to be considered. So therefore, I think there's a need for clarification, for instance, in the application of those indicative criteria to determine which party has economic control, clarify which IFRS respectively applies for the depositor client that records an asset are receivable and the intermediary holder. We need to clarify also the custodian credit exposure, whether that's relevant to determine the value of the receivable asset, and also a special situation like, for example, hard forks. What do we do when that happens? So in summary, I think in order to reduce diversity in practice and deal with this array of complexity, there is need for clarifying guidance in a more immediate manner than many other issues.
Anna, we've covered a lot of ground, and I must say many thanks for sharing your expert insights on some of the key issues that we raised in the EFRAG discussion paper with regards to holders of different types of crypto assets. As a final point, I would note that the discussion paper has questions for stakeholders on these various aspects of accounting by holders of crypto assets, including those that Anna has been able to discuss in this podcast. Thank you.
Right, it is now time for me to close this episode on accounting issues for crypto assets holders. A warm thank you to both our speakers today, Vincent Papa, EFRAG Associate Director, and Ana Rosa Cortez, Partner in Financial Services at KPMG Spain. Thank you everyone for listening and following us during this enlightening podcast. Let me remind you that EFRAG's discussion paper, Accounting for Crypto Assets Liabilities, Holder and Issuer Perspective, and all related information are available on our website, www.efrag.org, in both the publication and consultation sections. Your comments on the discussion paper are very much welcome by 31st July 2021. Thank you for joining us.